We'll do some trading here with our own Tom White in a moment. So, John, we're looking at records just around the corner if we close in the S&P 500. So right now it's been tech. We get more participants joining. What does that mean to you?
Yeah, I mean, I view the market really at crossroads here. As you mentioned, we're at near all-time highs, basically on almost every asset class. Look at bonds, look at gold, look at stocks. I mean, if you ran to cash in March, you're watching this whole train go by. But we're at a point now where the economy and the consumer and businesses came in from a position of strength in March when COVID happened, and people had, by and large, liquidity. Now we're 6 months past. We need this second round of stimulus to continue to build the bridge to provide you and I and consumers and businesses with more liquidity to buy time until a vaccine is approved and distributed to the masses. Because until then, if we start see a surge again in hospitals where the ICU utilization gets too high, governors will start to roll back their economy come the fall and winter. So that's the main data point I'm checking on here to see if asset classes can continue to rally.
So, John, doesn't from what I see, the data points on the virus look pretty good right now? I mean, we've had California and Florida struggling and over the last couple of weeks, but even some of the hot spots, including Florida, have started to turn around. The cases overall, I mean, they're moving down south pretty quick for the country as a whole, the curve moving lower. Do we need to have fast injection of stimulus if that's going in the right direction?
Well, I think so. To move, the market is pricing in I think what you're saying, in that people are feeling a bit more comfortable. You're seeing that we're trying to deal with this new normal of social distancing, but let the school year start. Let's see how this next wave is, because the market is already looking through 2020 and into a recovery of 2021. And again, from what Dr. Fauci and others are suggesting, when the fall and winter come around and you don't have the heat and people are contained to the indoors and the winter comes in, it leads for a faster spread of what is a very efficient virus. So in the meantime, I would expect the Fed to keep doing what it's doing. And what we need, though, is a second round of fiscal stimulus, I think, to provide liquidity to the general public.
Yeah. So, John, in terms of the size, I think the idea here about the yes or no kind of binary, do we get it, do we not, seems to be logically in favor that we do need something. But the size of it, how will we know as traders, investors, when there is some headline? Because we got the executive orders that were, trying to extend this, help, this lifeline. But when there actually is a headline, assuming there is one, that look, there's a deal being made, what's the number we look for? What are the components that will determine if it's market positive, if it's market negative? I mean, how do we gauge that?
Yeah, I mean, I think the larger the unemployment check, if we can get closer to that $600, which is where, on the benefits, which is what we were doing on the first round, I think the market would really cheer that. The 300 number that's floating around, I don't think that's overly positive. But then, we're going to have to check to see what happens with the unemployment data. Now, clearly, all the macro data seems to be moving in the right direction. You and I were living in this COVID social distance environment. I went to a Best Buy the other day. I spent some money. I went to another store the other day. So, this is all a big experiment to see how comfortable we could all be in spending money and realizing that, hey, we may or may not get sick. And where are we going to spend money? Are we going to go out to restaurants again? And as long as the hospitals can maintain their capacity utilization, and as long as the mortality rate continues to come down, or it's confined to these two groups that we know, that's those with weaker immune systems and the aging population, seniors and things like that have higher exposure, then I'm hoping that we go in the right direction here. But again, this is uncharted territory. We don't know. For all of us to price in a victory here, that we beat this thing, I think is it's a little too early for that.
So walk me through how, John, you express that right now as a portfolio manager, because it does seem like you have some reticence to really buying into the idea that there's events that can push the market quickly higher. It sounds like you think there's a good bit priced in here. So how do you address that in the way you're exposed, either stocks versus bonds or within the stock market itself on what types of companies?
It's tricky because right now everything is rallying. Usually, if you look at stocks and bonds, where are you going in the bond market? Short duration, short maturity bonds are earning nothing. And then if you go out longer term, well, then you're risking taking on a massive inflation risk. 30-year bond below 3%, the 10-year bond at 70 basis points. After inflation, after taxes in those situations, you have a negative rate of return you're locking in for 10 years. So the bond market is actually, I think, part of the riskiest part of an asset allocation. Then you look to stocks. We have this momentum trade being taken by tech, and the hurdle is very high for the tech companies. So where do you go? I really think that in an environment where interest rates are so low, investors are going to have to be looking towards dividend paying companies. Companies with strong balance sheets that have a history of growing their dividend, where they're earning a yield north of 3.5%. Dividends have been the second worst performing factor behind value year to date. And I think that's where there's tremendous upside potential, because at some point, particularly retirees who are trying to live off the cash flow of their portfolio realize, hey, I can't do it in bonds alone. And the Fed is printing so much money, they're forcing me out the risk curve. They're going to have me tippy-toe into dividend-producing securities, and I think that's where sort of the next leg of the market's going to be.
Okay, so is there something in your mind that will kind of cue that next leg? Is there a clear catalyst you'll be looking for to then say, okay, it's confirmed that this is happening, that there is real, potential for not just kind of stability but strength in this trade?
Yeah, well, if the macro data continues to creep higher, and we're starting to see it really over the past couple of weeks, I know you've discussed it on the show, is that inflation expectations are starting to creep higher. And once that happens, and if yields on bonds continue to compress, eventually the market's going to say, hey, wait a minute, time out. I'm not getting, inflation risk is starting to get priced in here, and my bonds are risky. And that's going to force a rotation into stocks higher. And then within the stock world, at some point, when we're valuing some of these tech companies, particularly in the mid-cap space, on 2025 and 2026 sales, for companies that are non-profitable, which a lot of Wall Street analysts are starting to do here to justify some valuations, the hurdle rate's going to be too high. And again, I think you're going to have a rotation down into those sectors that have not participated in this market rally. You're starting to see a little bit of industrials recently. The REIT space looks attractive. Financials will eventually catch a bid. So you're going to have a rotation. Right now in the stock market, what has worked is the momentum. So if a stock has worked over the trailing couple of months, investors are continuing to pour money into that on the hopes that works higher. Eventually, valuation does matter, and you're going to have a rotation down into what hasn't worked. So to me, the whole stage is set for high dividend producing companies with good balance sheets that generate cash flow should have its day in the sun. This is not to mean that just because a stock has a high dividend yield means it's going to do well. There's many ways to cut the lemon on dividend yields, but you have to do your homework. But I think north of 3.5% dividend yield, where the company has a lot of free cash flow, where their debt situation is low, I think that part of the market is going to do well over the next 12 months.